Anastasia, does this rally, if we're calling it that, does it have legs?
I think it does have legs, Scott, and I say this for a couple of reasons. Well, the main one being is that finally the technicals and the fundamentals seem to be better aligned here. So let me explain what I mean by that. It's interesting that the markets rallied off the level of roughly 3,900 on the S&P because that was the time when we hit an oversold level, for example, for the relative strength indicator on the S&P. And it was also around the same time that we reached a 16.5 times multiple on the S&P 500. What's so special about that? Well, when you look back and what the S&P multiple was back before COVID, it was about 16.5 times. And the Fed funds rate was about 2.25%, 2.5% then. So I think we may have finally priced in a fair multiple for the S&P, assuming there's no recession, assuming there's not a greater growth slowdown. I think that's why the market's been able to bounce off of that. Now, assuming there's no growth scare, and for the time being, the data seems to be cooperating here. This morning, retail sales were fine. Manufacturing activity generally is fine. So long as that's the case, I think the markets can build on this rally that we've had. Generally speaking, 3,900, that's kind of where I see support for the time being, Scott.
Okay. So, Jerome, the Fed chair, as we said, as I just said with Joe, he was tough, he was hawkish, however you want to take it. Does that mean that the market closed where it did today, that all of the Fed is now in the market, as Bullard seemed to suggest this morning?
Well, I think you have to actually look at what has happened. It's a bit of a sigh of relief. We really have to focus on the one key component, which Powell said, which there's an overwhelming need to control inflation. And if you look at that aspect, what we're finding is that the market reaction is one that liquidity or financial conditions have actually remained somewhat easy, although they've tightened over the past few weeks. But in a historical context, there's probably a little bit more room to go for those to tighten. Which means when you pair that together with what Powell again reiterated today about that focus on inflation, is that he's going to be quite comfortable with some weakness in the markets, in risk markets, going forward if that is going to be his juncture, where he actually wants to go, meaning fighting inflation over supporting growth in the medium term. And if that's the case, today's rally just simply gives him further runway to simply move a little bit more down the runway toward higher rates, and more importantly, to pivot toward that balance sheet reductions as another meaningful aspect of monetary policy tightening.
Well, I mean, the key is your wheelhouse, right? I mean, it's about credit.
Right.
He'll tolerate the stock market going down. He's not, and even though he said that financial conditions have tightened significantly, he's not going to deal in any way, shape, or form, or he's going to be forced to do something if the credit markets start to seize up, which they have not.
Right. And context here is important. Financial conditions have definitely moved tighter, but in a historical context, they're not anywhere near historical tights. Credit spreads, the same thing. We've moved from about 50 basis points in IG, CDX credit spreads to about 85 basis points. Again, not anywhere near the 125 basis point historical norms. So there's plenty of room here to tighten along the way. And simply when we think about this as an anti-Goldilocks environment, it's really not a reason to be a hero at this point in time. You've had front-end rates recalibrate significantly higher over the past few months, obviously offsetting some of the impact of what we think in terms of the Fed's road toward tighter monetary policy. But what is really done for investors is reset expectations for what we can find as a little bit of shelter along the way. People are going to have to adapt to not only changing financial conditions being tighter, but also changing liquidity conditions, which ultimately means for all the investors, being equity, emerging markets, bond investors, that they're going to have to find a way to immunize their portfolios from a little bit more volatility that is undoubtedly going to be coming their way because of these tighter liquidity conditions.
I'm going to roll with your don't be a hero thing. The question is, should you be a zero?
No,
right?
And that's the other thing, is that this is definitely not an environment where cash is trash. In fact, it's quite the opposite. Cash not only does one thing, which is immunize your portfolio from a little bit of volatility, but to the extent you can actually move out the spectrum and not remain in those money market fund eligible investments that are trading well below the Fed benchmarks, you can actually earn 3 to 4% returns with very limited interest rate duration. So the idea here is simply look at the landscape and how it's recalibrated over the past 3 to 6 months. And there's actually opportunities not only to create optionality, but not necessarily be over your skis in terms of risk allocations as we sort of see this market really evolving. And you have to be adapting to that evolving market in real time.